Hello, good afternoon. Thank you for joining us, our webinar today. My name is Jamal Khan. For most of you who are familiar with me, I'm a senior tax partner at Churchill Tax. I've got here today with me our tax director, Dave Jennings. Dave spent good 15, 20 years at HMRC as a senior tax inspector, and has worked for the firms in the past, and now has joined our team some time ago. Dave is very experienced in tax investigations of all types. I've got Nedim Ailyan from Abbott Fielding. Nedim is an insolvency practitioner and very experienced. Nedim will get a chance to discuss some of the hot topics for today or at this moment in time. We're also expecting Ali Zaidi to join. Ali is having an error issue of technology not working at the right time. So his computer's not allowing him to log in, but he should hopefully be joining any minute. Ali will also be covering some recent hot topics around impact of COVID and the new changes to the legislation. Can I ask, is Nedim going first?
Yeah, I don't mind going first.
Nedim, do you want to make a start and just talk about yourself first and about your topic?
Thank you very much, Jamal. Thank you. Good afternoon, ladies and gentlemen. My name is Nedim Ailyan. I'm a licensed insolvency practitioner. I've been working in insolvency for over 30 years. I did have my own firm, Abbott Fielding. Actually, as of last week, I merged in with a much larger firm, FRP. What I wanted to talk today about is the new Finance Act that came through in July of this year and has received very little press, but I think has got some very wide, far-reaching impact that's going to affect every aspect of every business. And I need to go back a stage because the government first wanted to talk about introducing this back in November of last year. And what they basically wanted to do was change the order of priority of payment of creditors. So very simply, when companies become insolvent, the order priority is always the fixed charge holder first, and that is typically of a fixed asset, which could be property or some specific equipment. Then you have what they called the preferential creditors in relation to employees for arrears of wages, holiday pay, pension contributions. Then it was the floating charge creditors, which typically tended to be your banks for floating charges. And then after that, there was a small part for a prescribed part, but it was the unsecured creditors as a whole. And HMRC fell within that for arrears of PAYE, national insurance, VAT, etc. In November last year, the government proposed that actually any arrears of PAYE, national insurance, etc. should become preferential. In other words, it jumps above the floating charge holders. We in the insolvency profession lobbied our MPs to reject this idea. We felt it was bad for business. It gave HMRC an excuse to actually petition for winding up of companies because they were now preferential. They'd become above the other creditors. And it just wasn't really economic. It wasn't fair on all the other creditors. And you have to remember, HMRC had a preferential status before, but in the 2003 Enterprise Act, they abolished that. They got rid of their preferential status. Anyway, we thought it was being put on the back burner. In March, the government said it was suspending it because of the COVID. And then into the July bill, they suddenly slipped it through. As far as I was aware, there was no real debate in Parliament. It just suddenly became law, and it becomes law on the 1st of December of this year. So what does that mean? Well, there are some huge implications. The first thing is now HMRC is going to become preferential. Under the previous act, they were preferential for arrears of wages for 12 months and for VAT for 6 months prior to a company going into liquidation. Now it's unlimited. So if you've got a 3-year tax bill with the Inland Revenue, that suddenly becomes preferential. Why does that impact on business? Well, the answer is quite clear. Most bank lending today will try and take a fixed and a floating charge. So the fixed charge, like I say, is typically over something like a property or a specific piece of plant and machinery. And actually the rest of their borrowing is in relation to floating charge assets. Banks historically felt comfortable that they would recover the money. They'd see what your balance sheet was, and they would say, yep, we know the assets are there. We can get our money back. But now, because HMRC is going to jump above the bank, every bank that I've spoken to, and I've taken the opportunity of speaking to HSBC, to Barclays, to NatWest, to Lloyds, are now going to revisit lending criteria. Why? Because they don't know, for example, if you have a debt of £100,000 to the Crown, and therefore, are they going to lend you the money on the understanding that they may not get that back? That was the first issue. And this is something that's we're going to see happen over the course of the next 12 months. As banks renegotiate their lending facilities with companies, don't be surprised to see the banks now asking for additional security against you, because they're aware that if anything happens to the company, and particularly given the fact that we have technically entered into a recession, they may not be able to recover their money through what they would think are the normal recovery routes. The second issue that affects is actually the secondary lenders. And this again applies to individuals like, say, Funding Circle that are very popular at the present moment. They've always relied on the fact that they will lend money to a company. The company may have an amount of assets, and if anything should happen to the company, they will share equally with all the other creditors. Now, for the first time, they're going to be finding that actually they're not going to be sharing equally with all the other creditors, because guess what? HMRC are going to be above them. And in the instance of HMRC, a lot of companies over the last few months have accrued Crown debt. And that is typically where either A, they've reached arrangements to defer the payments to HMRC, and HMRC have entered into time to arrange payments, or B, where they simply haven't had the money because of COVID restrictions and because of the fact they've had to cease trading, and HMRC have now said, look, we will give you time to pay. So we are seeing companies that have never carried Crown debt before suddenly having 30, 40, 50, and even six-figure Crown debt because of what's accrued. The secondary lenders, like the Funding Circles and the rest, now begin to realize that actually they won't be sharing equally in this, which brings two things. Now, typically they will take a personal guarantee anyway, so they'll be sitting back on their personal guarantees. But also we're going to find that they're going to be lending less because they will not share in as much as what's available to them. That's the second criteria to look at. And I'll look at these a bit in more detail later on. The third issue that we have seen, and I have actually had a number of insolvencies come to me already because of this, is cases where directors have been funding their own company. So I'll give you a specific case example. A director had lent £500,000 to the company. He had a debenture giving him a fixed and floating charge. Now, there's no fixed assets, so he's relying entirely on floating charge assets. During the COVID restrictions, his company has incurred Crown debts of about £300,000, and he's now possibly facing an insolvency. Now, here's the hypocrisy of the situation. If he goes into liquidation after the 1st of December, the Crown will take the assets first, and the assets are valued at about £400,000. So the Crown will take £300,000 of that £400,000. But if he goes into liquidation before the 1st of December, he will get £400,000 personally, because his floating charge will kick in, less the prescribed part, which is a small amount that gets taken away. So I've had a situation where there's been a lot of directors who have lent money into their company, are now experiencing financial difficulties, and are unaware that if they do go into insolvency after the 1st December, their debenture that they took out might be worthless. There might not be enough money to recover because Crown debt could supersede that. I've also had cases, and one particular chap contacted me. He has lent money into various companies because he found that he was getting a better return than sticking it in the bank. In all those instances, he's been taking debentures, giving him fixed and floating charges. And I go back to the point, he's relying on the floating charge assets. He's now realized that actually after the 1st December, his debentures, his floating charge assets may not be worth as much as they were before. Now, he's not lending huge amounts. He typically will lend loans into businesses up to £50,000. But at the present moment in time, he's got some in the region of £750,000 that's been lent out to a number of different companies. And his concern is actually, sorry, pardon me, How do I recover my money? And this is something that's happened because the government has introduced this with no real fanfare. I mean, it did slip under the radar and people aren't aware that there is this change in the law that is coming down. What we're also now starting to expect is that suppliers are going to go back to the days of pre-2003 and start insisting on a lot more personal guarantees. Now, I started back in the 80s, and during the 90s, we started to see the rise in suppliers asking for personal guarantees. Why? Because at the end of the day, they felt they were the ones taking the pain, because when a company became insolvent, who got paid first? Well, the bank did, and then HMRC. And there was very little, if anything, left for suppliers. Then the Enterprise Act came out. It took away the government's preferential status. And so suppliers were saying, well, do you know what? We're all in this together. It's the pari passu principle on which insolvency is built. Now the same suppliers are actually seeing that the Crown is once again taking a preferential status and going above them. Now, I do have some sympathy for the Crown's stance. The Crown is saying, look, basically, we're an enforced creditor. We don't ask to be a creditor of a company. We are enforced, and in a lot of cases, we don't even know how much we are owed until a company becomes insolvent. So why should we bear the brunt of the pain? But what you can't go away from the fact is that we are an entrepreneurial culture. You know, something like 98% of businesses are owned and managed, employing less than 10 people. And the Enterprise Act of 2003 was designed to encourage an entrepreneurial culture, and to my mind has worked pretty well. You know, if you look at the way that the UK economy has performed from 2003, we did have the blip of 2008, but that was a financial crisis across the whole globe. And actually, we as a country came out of that a lot quicker than other countries, because we are smaller businesses that were able to react. This new insolvency law is going to have some very far wide-reaching ramifications, and I think, unfortunately, is going to be counterproductive. It doesn't encourage an entrepreneurial spirit because there are some deeper hidden things within it. One of which is that under certain circumstances, HMRC now have the power to make a personal liability order against a director in the event of insolvency. Now, the bar is quite high on these steps that have to be taken, but nevertheless, they do exist. And the bar basically is if you've had previous insolvencies in the 5 years preceding. Unfortunately, A, a number of people have had insolvencies, and B, because of what's happening right now with the UK economy, and to be fair, the global economy, because of this pandemic, a lot of people are going to be having insolvencies that are no fault of their own. It is something that we are simply expecting as an industry to follow on from the first lockdown, the localized lockdowns, and the potential second lockdown. So that means that people could come out of this suddenly realizing for the very first time that they have breached the orders or the criteria that can require HMRC in future to make a personal liability order against them. What does that mean? Well, realistically, people aren't going to take chances anymore. I would not advise a director to risk his personal wealth when he feels that he has got a limited liability just because of some government lockdown that could force his business to cease trading. And already we are starting to see more and more directors approaching us to say, do I fall into this criteria? What do I have at risk? That's the first issue. The second issue, and it's a more of a personal issue. If you're a director of a company and someone says to you, if you become insolvent, you could end up owing money personally to HMRC, what are you going to do as a director? Well, the answer is simple. You're going to prefer HMRC. You're going to make sure that you make those payments to the Crown on time. And if you suddenly experience cash flow difficulties, who's that to the detriment of? Well, it's your other creditors and suppliers. Now, other people in business are suddenly going to find for the first time that they are at the back of the queue, irrespective of how much they think they are needed. Why? Because the directors of the company who owes them money are actually ensuring they keep their Crown debt up to date. It's not fair. It isn't. I mean, the whole principle on which this business was built on and which insolvency was the pari passu principle. And whilst HMRC are preferentially for, it was felt that that was unfair. The third thing that this can lead into, and this is also slightly of concern to us, if HMRC is a preferential creditor, it is in their interest now to issue more petitions to wind up companies. Why? Because if they wind a company up while it has assets, they will ensure that when those assets are realized by an insolvency practitioner, they are going to be paid because they're first in the queue. And they will rank above those floating charge holders. So we can see a situation where not today, tomorrow, and I certainly don't think for the next 6 or 9 months, HMRC will do everything it can to help people. But after that, I can see them becoming a lot more aggressive and a lot more draconian in their stance, because they know that the more companies they wind up early, the more money they are going to be getting back. And this, I don't think, is going to be a level playing field for a lot of companies, because, as I say, where I can see the issue arising is that more and more people will be knocking their suppliers and the people, their business partners, in order to pay HMRC. So if we go back a stage to what ranks as preferential, originally we were concerned that it would be everything. I have to say the full white paper hasn't been released. I haven't seen a copy of it. I've only seen the headline figures, and that's all our industry has been told. But what we are led to understand is that the preferential element is in relation to PAYE, national insurance, and VAT. So not corporation tax, which may or may not be a blessing. In a way, that is good, because don't forget that the furlough money that you receive does count towards income, and there could be a corporation tax liability on that. So I'm advising a number of companies at the present moment that have taken significant furlough money, have had no turnover over that period, and I'm thinking particularly in things like leisure industries, and are now going to potentially face a corporation tax bill. That is not a preferential element. But the PAYE element is going to be a preferential element, and the VAT, which was 6 months before, is now unlimited. What we also believe is in the documentation is that the penalties will also be preferential. And again, this is quite important, because the previous HMRC, there were certain bits that were not allowed into the preferential. So they fell down with all the other creditors. So what does that mean? Well, I mean, you could start off with HMRC, you owe them £50,000. They suddenly decide that they've got penalties and interest, and by the time they put it all up, you suddenly owe them £100,000. That's enough for them to petition, and that amount is all preferential. It gets paid first. It gets paid first in priority, not just to the other suppliers, but also more importantly in relation to people like the banks and the lending institutes. And these might be things that you have personal guarantees on. So I think the trick here is obviously proactive. That's the most important thing. I can see a lot more dialogue and a lot more engagement with HMRC going forward. The second thing is, I think that more and more directors will ensure that when the money comes in, the first people they are paying is HMRC. Now, this is exactly what the government wanted, but that is going to be to the detriment of other creditors. And also it's going to be to the detriment, I think, as the business as a whole, because you could end up getting to a situation where you can't actually go into business with someone without you having to give them a personal guarantee. And likewise, you may be doing business with other people where you're suddenly thinking for the first time, do you know what? I need to protect my position. I want a personal guarantee. So I think we're going to enter into a very difficult, more litigious period for the next few years. And that is purely because of the way the economy is at the present moment. You know, if the economy was booming, this wouldn't be an issue. And I think the only thing we can say in defense of the government is that when they first talked about introducing this, it was last year, certainly before this pandemic became an issue. So they probably had the best intentions in the world and said, right, we'll bring this forward. But the reality is this is the wrong time to introduce it. You know, when I wrote to my MP, believe it or not, I actually got a letter back from him confirming that he had sent it on to the Treasury Minister the day after the bill was passed. I wrote to him last December. So I wrote to him 6 months in advance of the bill, and I got the confirmation that he'd sent it on the day after the bill was passed. Make of that what you will. It might just be that he was busy. It might just be that he totally ignored it. But they did not listen to the business leaders. So I think where we go from here, I think firstly, people do need to be far more on top of their dealings with HMRC. Secondly, obviously engaging with your professional advisors, you know, people like Churchill. I think there is a lot more now to have a dialogue with them. If you do have debts to HMRC and potentially fall within this criteria of personal liability, then I think you need to be proactive in your dealings with the HMRC going forward. And again, this is something that Churchill can assist you in. And also give thought to the fact that if you have a debenture into the company, if you have made loans into the company, take a step back, look at the company's situation at the present moment and see whether or not you could potentially fall into this issue where if you became insolvent, would those debentures or piece of paper actually be worth?
Oh, brilliant. Excellent. Thanks.
So I was allocated 20 minutes. I've just overstepped this. I believe Ali Zaidi, the next speaker, is here now. So Ali, shall I pass over to you?
Well, we need Ali to switch on his camera first. Ali, if you click on the camera part, you're still here. There you are.
You got me.
We got you.
Okay. If nothing else, you've got to congratulate me on my timing because it has taken me since 11:30 to connect, and I got it absolutely spot on. So I think I will award myself a gold star for that. Forgive me, everybody, for that indulgence. But if I had hair, I would have been pulling it out by now because it's been an incredibly stressful 15 minutes trying to join. But nevertheless, here I am. So. Ned, apologies for missing your bit. Everybody else, welcome. Jamal, thank you very much for inviting me to give this talk. And I guess I will just go straight into it. So Ned, I know, has been talking about the provisions within the Finance Act 2020 to do with the Crown Preference. What I'm going to be talking about are provisions relating to the introduction of personal liability or directive in respect of tax evasion, tax avoidance. If you just bear with me for one moment, I mean, I literally just got onto this. Let me just grab my notes. Apologies for this. Those of you who don't know me, by the way, so I'm Ali Zaidi. I'm a partner at Edwin Coe. We're a 30-partner practice in Holborn. Being a lawyer, it's all about improvising. So I'm doing my best to improvise because I'm literally grabbing notes so I can give this talk. Okay, right. So as Ned has explained, so the Finance Act 2020 came into force on 22nd of July. Certain provisions don't actually come into force until December, but these provisions that I'm going to talk about are already in effect, and they're effectively designed to capture directors who HMRC believe have been involved in tax avoidance or stroke tax avoidance, or basically what they define as directors who have been involved in schemes which have artificially and unfairly deflated tax liability. And what these provisions are intended to do is to impose liability not just on the companies or the corporate vehicle that has been used for these schemes, but also the individual directors. And as I'll explain in a moment, these provisions are incredibly wide-ranging and extremely draconian in terms of who they potentially capture. So, for example, as you'd expect, what is called a personal liability notice, a PLN, can be served by HMRC on any director, which includes not just a director formally appointed and recorded at Companies House, but also a shadow director. So basically anybody who's involved in the management of a company. But it also extends beyond that to include what are described as participators and people who are involved in facilitating the participation in these schemes. Now, there's no strict definition of what any of these things mean, but effectively, it could capture anybody who is a director or involved in the management of a company which has participated in a tax avoidance scheme, irrespective of their own individual knowledge of the scheme itself. So, for example, even in a small company which has, say, 2-3 directors, only one of whom has responsibility for finances and liaising with the accountants and being responsible for setting up or participating in tax avoidance schemes, that doesn't excuse the other directors of their liability. The simple fact that you are a director of that company and the fact that you've delegated the decision-making process to another director to participate in a scheme does not excuse you from the personal liability. But it goes beyond that, because what these provisions provide for is not just the director, but anybody who is described as a facilitator. And that is typically, well, they define it as somebody who enables or promotes the scheme. So it doesn't matter whether you are formally appointed as a director. It could go as far as capturing somebody who is simply a shareholder of the company, or somebody who is a creditor of the company, who has invested money or capital in a company, provided that the director or the shareholder or the creditor benefits from the participation in the tax avoidance scheme. So again, it's a huge extension of the existing responsibility of a director. Now, just by virtue of the fact that you are a shareholder, would mean that you could be served with a personal liability notice. And again, if you think about that, incredibly draconian. Lots of people invest in companies. Lots of people decide to become shareholders. They don't want the management responsibility. They may not have the time to be involved in the management of a company. So they simply allow the directors to manage the affairs of the company. And if the directors decide, or just one director decides, to participate in a tax avoidance scheme, that shareholder, regardless of his knowledge, would still be served, or could still be served, with a personal liability notice, simply by virtue of the fact that he has in some way benefited. Benefit obviously would mean, for example, receiving an enhanced dividend, for example, or just the sharehold value increasing as a consequence. So incredibly wide, incredibly draconian. And what is particularly worrying about these provisions is the decision about service or a personal liability notice falls upon a HMRC officer. And in the past, where HMRC have got involved is where a company has actually entered into a formal insolvency process. So at that stage, where, sorry, Tanya, can you go back to the previous slide, please? So where a company has, say, for example, gone into liquidation or administration, liquidation, whether it's creditors, whether it's voluntary or compulsory, it's normally at that stage that HMRC gets involved and starts looking at the conduct of the directors. Not under this section, not under this Act. Under this Act, HMRC can intervene even before a company has gone into an insolvency process. So in other words, what the Act actually says is HMRC can serve a personal liability notice on a director or any of the other people I described, where not only if the company's gone into an insolvency process, but there is a serious possibility that the company may go into an insolvency process. And if it does, there is a likelihood that the company will not repay the tax liability. So just pause there. Just think about that for a moment. You could be a director of a company that's participating in a tax avoidance scheme, but you're still trading, you're still solvent, you've come to an arrangement with HMRC. HMRC suddenly says to you, right, we think you've been involved in tax evasion, you've avoided paying PAYE, NIC, corporation tax. Here's a massive liability. No, sorry. Here's an assessment that we've raised against the company. Whether the company is or is not able to pay that debt at that time, HMRC can immediately serve a personal liability notice on the directors if HMRC, in their opinion, think that somewhere down the line there's a serious possibility that the company will not be able to pay. So they don't have to wait to instigate an insolvency process. They don't have to issue a winding up petition. They don't have to wait for the directors to put the company into liquidation. It's just if they think at that time that there's a risk that the company will not be able to pay that tax assessment, bang, personal liability notice comes in straight away. And if you think about it, what I find draconian about this is you've got a HMRC officer who, let's be honest, is a civil servant based up in Glasgow on, I don't know, 50, 60 grand a year. He, in his subjective opinion, is for him to make a determination on whether your company, based in London or wherever, may not be able, at some time in the future, to pay its tax liabilities. Purely his subjective decision. Incredibly draconian. So, very powerful piece of legislation, and it applies to not just companies, it applies to limited liability partnerships. And as I say, it's not just restricted to those that actually participated in that decision, but also applies to anybody who's benefited from that decision. And again, another very unusual provision here is, normally when HMRC pursue a director, it's when the company, as I said before, is in an insolvency process. There's an extension to these powers where a company has actually been dissolved. Now, those of you who are company directors listening to this talk, you may have been involved in companies in the past that have been dissolved for any number of reasons. It could be because you just think, well, I don't need this company anymore, so I just allow Companies House to strike it off, or you strike it off yourself. Or maybe that Companies House takes steps to dissolve the company because you've not filed annual returns or accounts or whatever. And in the past, HMRC has just simply ignored that company and just said, well, it's gone, it's dissolved, it's gone. No more. Under the Finance Act, if the company has been dissolved, HMRC has the power to serve personal liability notices in the circumstances that I've described. Again, very, very draconian, very wide-ranging, almost unprecedented. So that's the joint and severable liability notices provisions in respect of tax evasion, tax avoidance. The second part of MITAL covers the non-payment of tax to HMRC. And Tyler, can you go on to the next slide, please? Thank you. So go back to what I was saying at the very beginning. What these provisions are intended to do is to cover what I described at the beginning as, on the first slide, as AEIN. So AE is companies and directors who have participated in tax avoidance, tax evasion. I and N stands for directors who have participated in companies that are insolvent, where they have not paid their tax. Okay? This is effectively an extension of a provision under the Insolvency Act, Section 216. Now, 216 of the Insolvency Act of 1986 was about trying to impose personal liability on directors who have participated in Phoenix companies. Some of you will be familiar with that term. In fact, it's quite a popular term if you've been following the press about the rag trade in Leicester. This is a really prevalent problem where basically, let's say, for example, you set up a company called Rag Trade Limited, you trade it for 12 months, you pay all your suppliers, you pay the directors, you pay your shareholders, but you don't pay HMRC. Company then gets put into insolvency, and then lo and behold, the next day another company gets set up called Rag Trade UK Limited. Exact same thing, everybody gets paid apart from HMRC. A year later, lo and behold, same thing happens, and you get a third company, this time called Rag Trade, in brackets, Up Yours HMRC Limited, etc., etc., etc. And what 216 did was impose personal liability on directors for continually doing that sort of thing. And, I've acted in the past for a couple of directors who've been caught by this, but the Finance Act goes way beyond 216 for reasons I'll explain. And in particular, what this does is it empowers HMRC to serve what's called a joint liability notice, so a JLN, a joint liability notice on a company and an individual director. The circumstances for the director being served with the JLN is where he has participated in 2 companies in a period of 5 years, where those 2 companies have been guilty of either A, not paying tax, whether it's PAYE, NIC, VAT, or B, have failed to file their tax returns. And in those circumstances, if that individual is a director of a 3rd company, they can be served with a joint liability notice, which imposes a personal liability on them for the outstanding tax of the first 2 companies and the 3rd trading company. So let's walk through the example that I've given you. So Rag Trade Limited sets up, trades for a year, owes HMRC £100,000 for non-payment of PAYE NIC, goes into liquidation. A new company set up called Rag Trade UK Limited, trades away, doesn't pay its tax, goes into liquidation. And then the 3rd company gets set up. And you have a common director of all 3 companies. What these provisions allow HMRC to do is to say to that individual, right, you have participated in at least 2 companies in the preceding 5 years that have failed to pay tax. In the first 2 companies, each of those failed to pay £100,000 to HMRC. You are now personally liable for that £200,000. Oh, and by the way, that 3rd company, which is trading very profitably and doing very nicely, but by the way, we've noticed you've got an outstanding VAT liability of 20 grand. You're personally liable for that as well. So that's £220,000 personal liability. Thank you very much. That's what this provision does. And you think about it, it's worse than that, because go back to what I just said. It's not just non-payment of tax, but also the failure to file returns. So you could have a situation where an individual, director of a company, goes into insolvency owing, for argument's sake, £100,000 to HMRC, quite innocently. Okay, there could be any number of reasons why HMRC will creditor. That individual is then a director of another company, which, for reasons that he's not even aware of, fails to file its VAT returns. Right? He doesn't even know that because another director, or he's got, an office manager who's responsible for that, and that office manager fails to file the VAT return. Bang! At that point, the director is personally liable, even though he quite innocently didn't know, or quite innocent reasons why HMRC were owed money in the first company, and quite innocently didn't even realise a return hadn't been filed on behalf of the second company. That's the trigger points. Think about that. Think how draconian that is. And the consequence to the director, suddenly you are facing personal liability. But it's worse than that. Because, as with the provisions regarding tax avoidance and tax evasion, any other director who's also been a director of the same companies could also be personally liable. So, you could have a situation where a husband and wife, for example, directors of a series of companies all the way through, all of them, both of them, become personally liable, even if only one of them has been involved in the management of the company. So again, very similar, very powerful. And the final point I want to make about this particular provision is Section 216 was used to capture what I described as the Phoenix situation. So, you have directors of very similar named companies. In the example I gave, Rag Trade, Rag Trade, Rag Trade. This provision goes beyond that because it captures a director regardless of the name of the company. So it doesn't matter what you call the second or third business, you are still going to be the subject of this provision. So let's say, for example, in the example I gave, you are director of Rag Trade Limited, goes into liquidation, owes 100,000 to HMRC. You set up a second company called, I don't know, Leicester Doesn't Care About the World Limited. That company goes into liquidation. You then set up a third company saying, COVID, what's that limited? Irrespective of what the names of the companies are, irrespective of the kind of trade, if you are an individual director, as an individual, or director of those three companies, in the circumstances I've described, you are going to be caught by these provisions. That is my whistle-stop tour of my talk. I don't know how long I've been speaking for because I'm just run straight into it, literally. So apologies if it seems a bit rushed or a bit flustered, but I timed it perfectly to join. And as with Nedim, I'm here for any questions. Otherwise, Jamal, I don't know whether you want to defer questions to later. I don't know if there's a follow-on speaker, but I'm in your hands, Jamal.
We've got another session. Dave will be covering that. But I've got a couple of questions here. Is CIS liability captured by the new rules?
Yes. It's any liability, PAYE, NIC, VAT, corporation tax, CIS.
Scary stuff.
And, sorry, apologies, and penalties. This is another thing that's very unusual about these provisions. HMRC can impose personal liability for penalties and interest.
Right. Okay. The next question I've got here is: what if the director is 50% shareholder in any third company?
In what context? Sorry, Jamal.
I don't know. I mean, somebody's asked, what if the director is 50% shareholder, third company? I don't know what that means. It's come from a mood and hasn't elaborated on this question. But if he's a shareholder in a company, then he's got no way out anyways, is there?
No, I mean, in terms of tax avoidance and evasion, as I said, if you're a director, you are the obvious target. If you are a director and a shareholder, you're even more a target, because go back to what I said earlier. Under these provisions, anybody who has benefited, so if you're not a director but you still benefited because you're a shareholder, you are also liable. So if you're both, you're an even bigger, more obvious target for HMRC. And I would say, particularly in small companies, particularly family companies, where, you know, quite common, you'll have husband and wife, both directors, both shareholders, that I think are the prime targets for this legislation. What this legislation is trying to do is say to directors, listen, you have a responsibility as directors, right? If you want the benefit of hiding behind the corporate veil, of avoiding personal liability, we expect you to behave in a certain way. We expect you to observe all your duties under the Companies Act and behave in a way that a director is meant to do. And if you're going to abuse that by using tax avoidance schemes, then fine, but you suffer the consequence. You take the personal liability. And ironically, what I suspect is going to happen now is, there are plenty of individuals and probably people on this call who are professional directors who will take directorships of various companies. If you're a director, you seriously need to be thinking about who your co-directors are. Are they the kind of people that you trust to manage the affairs of this company? And if you don't trust them, you need to seriously think about whether you want to continue as a director, given the potential personal liability.
What if they're indemnified?
Well, indemnified by who?
By the other directors.
Well, in theory, yes, but as long as you're satisfied that the directors are good for it. But again, bear in mind, the indemnity is only of value if the director can honour it. But if that co-director is also being pursued by HMRC, you've got to ask yourself, well, what's the value of that indemnity? I mean, some of these claims by HMRC are going to be substantial. So if you're all jointly liable for an assessment for $500,000, you've got to think to yourself, well, I know my co-directors, I've got to fork out $500,000 to HMRC. Would that impact upon their ability to also indemnify me if I've also got to pay HMRC? I'm not sure the indemnity is an answer unless you've got a fabulously wealthy co-director.
I've got a number of questions here. I don't want to kind of step into Dave's session, but one's a funny question, so I hope you won't laugh. It says, I have a BBL loan of 30K. Can I liquidate the company and forget about it? This is my first company.
The short answer to that is no. Ali and I were actually in a seminar given by a barrister who does a lot of work for HMRC, and any company that's taken any government aid package is on a separate database right now. So if you take the 30,000, liquidate and think you're going to get away with it, I hate to disappoint you, but no, they will come after you.
Right. Okay. There are some more questions, but I think we'll let Dave start his session. Dave, I'm sorry, but yeah, things have dragged on. But would you mind shedding some light on some of the tax investigation areas? Because these two are quite close to me. So whatever happens is usually start with you, and then go to Nedim and Ali. So you will handle the investigations, then you'll talk to Ali and Nedim. Please, Dave, if you share your slides.
Thank you, Jamal, and welcome everybody, especially some of our guests who've joined us from the IG postcode, who've been invited specifically to this webinar. I hope you're enjoying it so far. I lead the tax investigation team here at Churchill Tax. I'm an ex-Inland Revenue HMRC Senior Inspector of Taxes and also a qualified chartered tax advisor. I spent nearly 19 years in the revenue investigating individuals, multinationals, high net worths, partnerships, etc. And the last 14 years helping clients facing investigations by the revenue. So gamekeeper turned poacher, 30 odd years experience dealing with everything from both sides of the fence, tax tribunals, criminal tax prosecution, and your standard investigations. What I'm going to talk about this afternoon is the revenue's information powers. And I'm just going to see if I can get the technology to work to share my screen with the slides, and we'll run through that. Can you see that, Jamal?
You're good.
You can see the slides. Good. Excellent. Thank you very much. So what happens when the revenue issue demands for information? But very, very briefly, just this is a very hot topic at the moment. We are seeing lots and lots of people receiving what's known as nudge letters from HMRC about previously undisclosed, undeclared offshore income. This is due to the countries around the world signing up to share financial information between different countries. The UK sends information to overseas authorities, and likewise the overseas authorities since 2018 have been sharing information with HMRC. We are seeing a lot of letters from the revenue saying, have you declared your income? Please check. If not, let us know. If you have, great, equally confirm. And obviously you need to be very, very careful before signing any certificates, especially if you attempt to sign a certificate saying everything is fine and actually it isn't. We are seeing people with undisclosed tax liabilities that arise from savings, investments, property, corporate shares, etc., mainly in India, Hong Kong, America, Germany, and France. We do say take advice before signing certificates. Please obviously come to us. We are very, very experienced in the worldwide disclosure facility. We are dealing with dozens and dozens and dozens at the moment and have been doing for the last few years. All our cases get accepted by the revenue. Sometimes they ask a few questions afterwards, but please ask us for assistance and help. We can help you and your clients with the worldwide disclosure facility, which might be the best option to regularize and catch up the past, or potentially if it's more serious and fraud is involved, Code of Practice 9, which we covered in a previous seminar. So the information request that the revenue can issue, there is specific legislation about that, which also covers penalties for failure to comply, and there is an appeal process. You may be familiar with HMRC investigations, and they usually start with an informal request for the information. And we would usually advise to cooperate with the revenue. However, you need to robustly challenge what the revenue are asking to make sure they're not just fishing for information and that it is relevant to their inquiry. They do have to have a suspicion of tax not being correct in order to request information. You also have to be mindful that if you send information voluntarily to HMRC, you do need to be careful that you're not breaching any further client confidentiality or any other Data Protection Act rules for the data and information you're giving to the revenue. So be mindful that you're not infringing any other non-tax rules around data information that you give to the revenue. And sometimes you may actually want to ask the revenue for a formal notice rather than an informal notice, so you're covered to avoid any third party or anybody else whose data it might be relating to being ultimately finding out about it and potentially at worst case scenario suing you for providing information to the revenue voluntarily that you shouldn't have done. That's obviously in the worst case scenario and very few and far between, but something to be mindful of. The rules do have certain protections in those as well, and we'll cover that shortly. So if beyond an informal, so if either you request a formal notice because you think legally that's the best way to comply, or you fail to comply with an informal notice and therefore the revenue moved to a formal Schedule 36 notice, then this is what happens. Sometimes the revenue may go straight to a formal notice at the beginning of an investigation. There are three main classes of people they can issue a notice for. First party notice, which is on you, the taxpayer, your client. A third party notice on somebody related to the client. That might be to a supplier or customer. The revenue wants information from them to back up what they're doing with their review and investigation, or to back up what you've said. Third party notices can be held through the tribunals, but they are ex parte. You don't have a right to attend, and the revenue are looking to change those rules to even make it more draconian that you might even lose any possibility of representation against third party notices. So watch out for a change in the future. The final class is a mass information request, which are quite common. The revenue can issue notices to banks, for instance, for information about all their clients' interest receipts, payments that the bank have made, or say for an estate agent for their client lists, things like that. The information request has to be in writing, and it can be for information or documents. So that means questions. The revenue can ask questions or they can request documents, but they do have to be in the recipient's power or possession and reasonably required for the revenue's investigation. Statutory records, on the other hand, have no right of appeal whatsoever. So if the revenue issue an information request for what's known as statutory records, you can't stop that. You can't appeal against it. What is an anomaly is that there is no strict definition of what are statutory records. There have been a few cases that have gone to the tribunal to try to define what they are, or are these particular items the revenue have asked for statutory records. Sometimes they are, sometimes they're not. It doesn't help us to exactly define what they are. Generally, the rule in the legislation is anything that is meant to be kept to complete the accounts of the company or the business. But there can be grey areas over, well, what are those records? Which accounts are relevant? Is it the purchase invoices? Is it the cash book? Is it the book you keep under the counter? Which one is statutory? Which one isn't? To be in your possession, then you have to have a copy. To be in your power, you have the ability to obtain a copy. There are two grounds, power or possession. What you need to be careful for is if the revenue, say, ask for emails that have been sent to and fro various parties. They can request this. They do have a right to ask for emails, but you do have to be careful if you receive such an information notice whose possession are those emails in? If the investigation is into an employer, for instance, do they have the power and possession of their employees' emails? Vice versa, if the inquiry is into an employee, can the revenue ask for the information of emails that are on the employer's server? Are they in the power and possession of the employee? No. Would they have to issue a third party to the employer? Possibly. So again, got to watch whose power or possession is the document. There is some protection, as I mentioned earlier. They can't go back more than 4 years if someone's deceased. They also can't go back beyond 6 years for certain documents and information. If the documents or information have been created as part of an ongoing tax appeal, they can't request those with a Schedule 36. They might have to be disclosed as part of the appeal process instead. There are also rights and protections around health and anything that's personal to an individual. They're protected, as is privileged document between a lawyer and a client, specifically relating to legal advice. Tax advisor documents and papers, as our auditor's papers, are also protected. But if you don't comply with an information notice, you can be issued with a fixed penalty of £300 or a daily penalty if it continues not to be complied of £60 a day. There is a right of appeal against those penalties as well. So what appeals can you make against the information request itself? You can complain or appeal against the validity. It might be an invalid notice. It could have wrong names, wrong details. There could be all sorts of statutory rules that haven't been complied with. Is the information itself specific, or is it too vague? Or could it be way too onerous or disproportionate for the inquiry or for the business to obtain and to provide that information? If it's too voluminous, then it's just unreasonable. Again, we covered power and possession. If it's not in your power and possession, you've got a right of appeal against that. And the appeals against a penalty and not complying with the information, you would have to have a reasonable excuse. That's been a whirlwind trip through HMRC's powers and the right to request information during an inquiry and the penalty they can issue and the right of appeal. Jamal is our business partner and owner here at Churchill's. Please contact Jamal if you've got any queries and questions about tax planning and investigations. And there are my details myself. I will now go back to our screen. There we go.
Thank you, Dave. That's very useful. And from what I know and from what I'm starting to see, because we're getting new inquiries, we have been getting new inquiries since September, beginning of September or mid of August. There are more and more tax investigation inquiries coming in. HMRC are taking a tougher stance. What I do say to the clients is, whoever you appoint, whatever league, whatever phase you're in, or whatever you're going through, get the best help you can, and don't rely on an experienced person. Some people try to save costs. I think we've seen that they try and handle it themselves, or get an ordinary accountant to handle. The accountant gets into trouble, the client gets into bigger trouble, and now with what Ali and Ned have been mentioning, you don't have that cushion anymore. They will jump on you. HMRC will jump on you, and I think it's when it comes to the government recoup money, it's given away to help the economy and people. I think people, as Ali said, that you've got to be very careful in terms of your position as a director in any company, or they will come and bite. How long can the Schedule 36 penalties go on for? Okay, that's one question I have for you here.
The Schedule 36 penalties can go on for potentially forever. They can keep issuing daily penalties, and they can obviously rack up. Potentially, if you continue to not comply, the revenue are going to issue estimated assessments. They can issue tax-geared penalties for failures. And in the worst case scenario, they can even obviously go criminal if someone is not compliant, and it's very, very serious. But they can just keep issuing daily penalties, £60 a day for not complying, and obviously they're going to rack up.
So then coming to Ali and Ned, somebody's been issued a notice and then they've got personal liability. What if they do not have enough assets to cover?
In the most extreme case, the revenue can petition for a bankruptcy.
Okay.
Whether they will or not is another question. I mean, you know, they'll it depends on the circumstance. I think every case will be judged on its merits. The one thing the revenue do say to us is they always look at the compliance history of the individual.
Sure. I mean, I do know some clients who wouldn't mind going bankrupt because they've got built up a load of credit card debts already and other bank loans. But then again, I do know some other clients who would do anything to avoid bankruptcy, even if they don't have enough assets to cover their liability.
If they don't have enough, you always have options like, say, an individual voluntary arrangement, you know, but that's coming to a deal with the revenue.
Well, how do you apply in larger companies where, for example, a potential shareholder can be held responsible based on what Ali was saying earlier? That a shareholder has benefited by receiving a larger dividend. But for larger companies, say PLC, or how will that be applied in those companies? Ali, on mute.
Sorry about that. This is totally uncharted territory, and this has never been tested in a court. We've never had legislation like this, so very difficult to know. But actually, Jamal, if you think about it, it's more complicated than that, because it's not just the shareholder, but let's say, for example, you are an ultimate beneficial owner, say 2 or 3 companies away. So quite typically, you'll have a subsidiary which is wholly owned by another limited company, which is wholly owned by another limited company, which is then ultimately owned by an individual. Now, what is not clear is who is the shareholder for the purpose of receiving the personal liability notice. Is it just the actual shareholder, which might just be another limited company, or is it the ultimate beneficial owner, which is 2 or 3 companies away? And I suspect under this legislation, it's the ultimate beneficial owner. So, incredibly draconian, very wide-ranging. Will HMRC try and take it on? I don't know, is the answer. I suspect there's going to be an element of using this to threaten certain individuals who they believe have regularly participated in tax avoidance, stroke evasion. But yeah, your guess is as good as mine as to how these provisions are actually going to be implemented, particularly against shareholders.
Next question I have here is, these are the questions that I covered earlier, is if somebody was a director of a company, they resigned, they moved on to set up another company, it's maybe 12 months, 24 months, and HMRC are now investigating the previous company he was director of, and then will they come after the director, even if he's resigned, and it's been, say, 1 year or 24 months, or maybe more?
So under these provisions, you have to be a director of 3 companies. So 2 that have gone into a formal insolvency process, and then become a director of a 3rd company, which is trading. So if, in the example you've given, you've been a director of just those 2 companies, but you don't take a directorship of a 3rd company, then in theory, you're fine. HMRC may not come after you. But of course, don't forget, with those first 2 companies that are in insolvency, if there's a liquidator appointed, the liquidator could equally investigate the conduct of the director under their powers under the Insolvency Act. Ned and I do a lot of work where we are looking at companies where directors will very often, what's described as trading at the expense of the Crown. So in other words, they trade, they pay off all the creditors, they pay themselves, and their wives as directors and shareholders, but don't pay HMRC. That is a classic excuse for a liquidator to pursue the director, and also for the director to be disqualified. I mean, I do a lot of work defending directors who are facing disqualification, and the classic allegation against them is that you breached your duty as a director because you basically paid everybody else, but you left HMRC high and dry. So, it doesn't matter whether it's one company or two companies. Don't think as a director you're going to get away with avoiding being pursued for non-payment of tax. That there are plenty of powers under the Insolvency Act to pursue a director.
Okay, sounds scary.
I mean, what I will say, can I say a couple of things? This is new legislation. I don't think we're going to see the revenue really enforced over the next 12 months because of the state of the economy, But it is something there. And I think once the dust is settled in 2-3 years' time, yes, the revenue will use these provisions to go back on companies that experience financial difficulty. And as Ali said, on directors or shareholders that have benefited from tax.
Sure. Excellent. Well, thank you, Ali, Ned, and Dave. And I think we've answered the questions, we've covered the areas. Recordings will be sent out to our audience as well if they have any questions. Ali, could you say your email address or contact details if somebody needs to contact you?
Yes. What I can do is when you circulate the recording, I will attach my contact details, including my personal Edwin Coe email address, and of course, as with Nedim, more than happy to answer any individual's queries or questions. But yes, I'm more than happy to circulate those details to you.
The same for you, mate?
I will do. We'll get that over to you.
Excellent. Well, thank you so much for your time, guys.
Thank you very much. Thank you,
everyone. Goodbye, everyone. See you next month. Thank you. Bye-bye.
Yes. Bye-bye.